From Impact Alpha, it's This Week in Impact, where we bring you some of the most interesting impact investing stories of the week. It's Friday, May 16th. I'm Brian Walsh, and I'm joined this week by Impact Alpha editor David Bank. We'll discuss two views on the future of impact investing from Calvert Impact and the new Innovative Finance Initiative. Plus, Temasek makes the case for the private equity opportunity in climate adaptation and resilience. And finally, how Monte Carbon plans to leverage its $50 million X Prize to remove carbon and support farmers in tropical zones. That's all coming up on This Week in Impact. Hi, David. How are you doing this week?
I'm doing great, Brian. I hear you're in Rwanda.
I am in Rwanda. I'm here for the graduation from the Agahozo Shalom Youth Village, a great organization that I happen to be on the board for. And we are also here for the board retreat. Really excited to be back in Rwanda. It's my first time here since 2019, so before the pandemic.
I know you've been working on that project for years, and it's a terrific effort.
It's always great to be back here. But let's dig into impact investing. For our first story, we published two views this week on the future of impact investing, one from Calvert Impact and a new project, the Innovative Finance Initiative. Let's turn to the piece from Calvert Impact first. Calvert Impact is a global nonprofit investment firm whose president and CEO, Jen Price, makes the argument that impact investors need to become something more than they've been to date. Namely, they need to become capital market shapers. David, what does she mean by that?
Yeah, there's kind of a general impatience with impact investing. I think it responds both to the vibe out in the broader economy and polity, as it were, for solutions that really put money into people's pockets or improve the lives of people who have been left behind by the economic system. And then it also responds to this notion that impact investing kind of hasn't done enough over the last 10 or 15 or 20 years to really change the systems that resulted in those outcomes. And so there's kind of a move on to kind of lift the game, as it were. And Jen Price at Calvert Impact calls that market shaping. It's not enough just to do deals or raise another fund, but actually change the way capital flows and overcome some of the structural limitations that have blocked those flows. So that could be things like the size of deals, like impact deals tend to be smaller. Institutional investors really like to put down bigger checks because of the transaction costs or data gaps. We've talked a lot about how risk is mispriced, and so even though maybe small business or emerging markets are not really in fact any riskier than other kinds of investments, investors think they are, and mostly because they just don't have enough data, or even sometimes just this sort of inescapable fact that if you have positive externalities from your investments, that doesn't always flow back to your investors. So mainstream investors in particular think, well, why should I fund that? And so how can you kind of change the way that people perceive and measure and account for their investments so that you can get capital flowing in a different direction?
So what needs to be done differently then?
Well, we love Calvert because they actually have come up with quite a number of solutions over time. Things like securitizing loans from community development financial institutions so that capital can get recycled back into further loans. They were very key in the development of some of the solutions that are, for the Greenhouse Gas Reduction Fund, that are now been sort of mired in court battles for the last few months, but that would put develop new green lending techniques that would lower utility bills and improve air quality and other things in disadvantaged communities. And I think the call to action here is to get a much broader set of asset owners and asset managers to work together to kind of overcome these structural limitations.
Yeah, what I really appreciate about her piece is that she hits on this theme, and I like this line here, quote, "We recognize that not all market failures can be fixed with finance." So I like that because that kind of gets at the humility, if you will, of impact investing as an approach, that it is an approach that can help drive more access to credit and capital and help change market dynamics, but it's not going to be the cure-all for everything that ails us as a society.
Yeah, that kind of gets to the original sin of impact investing, which at some level is just a better form of wealth management or asset management. And when when many of the folks who've been working in the field, are really aiming at something much bigger, sort of the transformation of global finance and global financial flows and optimizing for social and environmental benefits. And those things, sometimes work together and sometimes are at odds.
All right, well, that actually creates a nice segue to the second guest post we had on this theme. This one was from Ani Patent Power of the Innovative Finance Initiative, and Erinch Sehan of Donut Economics Action Lab made the case for what they're calling Impact Investing 3.0. So, David, where do they see the future going?
Well, it's a similar impulse. They say the tools we have developed as a field have largely failed to scale or radically change traditional financial market architecture. Ours instead have mostly tried to fit in. So again, what are the kind of more systemic or structural ways to move forward? And again, they're also trying to rally, asset owners, family offices, foundations, impact management, tax, legal, structuring experts into kind of a design thinking process around the purpose, the structure, the incentives, the governance, and in particular the exits for impact investments, which has become a very hot topic, both because there's not enough of them and that the ones that do come about, sometimes you lose the impact.
So, what would a better mousetrap in the impact investing space look like? What's a better structure to get the exits that generate the real impact that they're imagining?
Well, again, and maybe a second original sin was that impact investing kind of took on the trappings of venture capital, and this kind of classic 2 and 20 fund structure, and 7 to 10 year fund cycles, and that is not always consistent or aligned with the impact you want to have. So they talk about things like permanent capital vehicles and open-ended funds and holding companies and even nonprofit vehicles, crowdfunding, and various kinds of syndication models that kind of get out of the kind of just basic structuring of the funds. So they're very much in the nuts and bolts of what a fund even should be.
But isn't that fund design and the fund structure and the incentives for the funds, isn't that really based upon the LPs into the fund? So if the pools of capital are interested in those models, then those models should come about. But it's about changing the mindset of the capital owners and allocators then?
Exactly, Brian. I think you hit the nail on the head, and that's where a lot of these efforts to kind of move the field forward or transform the structure or overcome the kind of limitations have run aground in the past. Which is the asset owners and the allocators have to buy what you're selling, and for example, holding companies which are seen as maybe having the possibility for higher impact. You don't have to exit right when you get that operating company tuned up and delivering the kinds of products and services and thus impact that you're looking for. But LPs have said, well, we need more liquidity or what have you. So if you can't raise the money for that new structure, then that new structure can't have the impact that you think it might have. So again, we can design and think about the structures we'd like to see, but ultimately, the folks with the capital have to decide that that's something that's of interest.
All right. Well, you can read these guest posts about the future of impact investing from Calvert Impact and the Innovative Finance Initiative on impactalpha.com. There's also a link in our show notes. You can also weigh in on the conversation on our Slack channel that's exclusive for Impact Alpha subscribers. But David, for now, let's take a quick break. When we come back, making the case for private equity opportunities in climate adaptation and resilience.
The Activist Podcast is where we talk to folks leading the way on place-based impact investing. Every week, the team from Activist and Next World Assets catch you up on how public budgets and tools of finance can move us into an equitable future.
The world isn't ending, but this world is, right? We have the opportunity to shape that.
Join us for deep dives on fiscal justice topics, insightful conversations, and visits with guests. Check out the Activist Podcast on the Impact Alpha Network and on your favorite podcast platforms too.
The term A&R is not just for the music industry, it now also stands for adaptation and resilience, as in climate adaptation and resilience. Our Amy Cortese and Jessica Pothering covered this week a new report from Temasek, the fund owned by the Singapore government and the Boston Consulting Group, which makes the case for the private equity investment opportunity in climate A&R. So with governments and companies backtracking on climate commitments, the need for investments in adaptation and resilience to adapt to climate change will only continue to grow. David, how big is this estimated market opportunity? And you can give us some examples of the types of investments they're talking about here.
Yeah, it's one of the kind of ironies of climate investing that the worse things get, the better your adaptation and resilience investments might perform as you know they're more and more needed. And as we've blown through the 1.5 degree milestone, you know, the climate catastrophe is upon us. And particularly, it's interesting that Temasek, which, as you say, is based in Singapore and is a Singapore government-owned fund. But also, there's another Singapore government-owned fund, even bigger, called the GIC. Temasek's got something like $330 billion under management, and GIC's got something like $800 or $900 billion under management. They both put out reports this month on climate adaptation and resilience. And Singapore is particularly, you know, vulnerable. It's a low-lying, you know, kind of island state. It's got doesn't have a lot of room to grow its own food. They've put a very big premium on trying to attain food security, you know, greenhouses and other things. So they are very much attuned to, you know, sort of adapting to climate change. And the GIC research showed that the annual revenues from some set of climate solutions today is something like $1 trillion, and it's likely to quadruple by 2050 to $4 trillion. The Temasek report broke down areas that are really growing, and so things like risk analytics and hazard warnings, you know, climate intelligence is expected to grow 15% a year over the next 5 years. Flood defense systems could grow as much as 10% a year, and then the whole category of kind of climate resilient building materials, both, you know, wind resistant and flood resistant, are expected to grow like 8% a year. So that's just a sampling of areas that they see, you know, are going to have the inevitable growth because of the increasing risks.
So this market opportunity is growing for maybe all the wrong reasons.
We've called it the inevitable opportunity, and it essentially affects everything. I mean, at some level, you know, many or most investments are really going to have to be adapted for climate, whether it's, you know, in insurance or housing or food. So biodiversity, water, energy. So it's a huge opportunity space. It's funny because, you know, in the past it was seen that climate mitigation, as in, you know, reducing carbon emissions, was where all the money was going, and adaptation was kind of the poor step sibling. But now adaptation is really coming to the fore.
Right. So we've blown through prevention, and we're now onto adaptation and resilience in the face of this coming storm. What I want to understand better, though, about these reports is are they saying that this is the market opportunity as it exists today, or are they saying that this is what is needed to fund these solutions?
No. They're much more in the opportunity mode as opposed to the kind of financing gap mode. And Impact Alpha has long made the case that, you know, people don't fund gaps, they fund opportunities. And these are, you know, going to be, you know, companies and innovations that make money because, you know, they're going to be more and more needed.
Right. And there's a first mover advantage here, right? In private equity, if you can get in early and help those companies that have these A&R solutions, then you can help be part of the solution set, but also be a part of the upside as these become more needed.
The Temasek report made that point about the urgency, not just because of the need, but because the other folks are getting in, and some of these companies are getting swallowed up already. And there's been some consolidation, particularly in the kind of analytics and reporting field. And so, if you want to be a climate adaptation and resilience pioneer or early mover, you better start getting in there.
All right. Well, you can read Jessica and Amy's full story on the private equity investment opportunity in climate adaptation and resilience on impactalpha.com. There's also a link in our show notes. For now, let's take one more quick break. When we come back, we'll discuss how Mati Carbon plans to leverage its $50 million X Prize to remove carbon and support farmers in tropical zones. A Houston-based nonprofit beat out VC-backed startup companies to recently win the $50 million X Prize competition. David, tell us about Mati Carbon and their innovative nature-based approach to carbon removal that also helps farmers.
Yeah, the X Prize carbon removal competition, you know, they actually have to deliver the carbon removal. So all the winners removed at least 1,000 tons of carbon over the course of a year. And Monte Carbon, as you say, won the first prize, which was $50 million. It was interesting. It was backed by Elon Musk's foundation, put up the prize money. And all of the top 3 winners were sort of nature-based, soil-based carbon removal. So you might have, thought that there was going to be this direct air capture kind of high-tech version. They kind of fell by the wayside in the competition because they have to, use energy to remove the carbon, and so that at least at some level, unless it's completely renewable, they're creating carbon while they're removing carbon. But these soil-based solutions, generally speaking, are much more efficient and essentially rely on kind of natural processes. In Monte Carbon's case, they have what they call enhanced rock weathering, and I think that's a kind of basalt and other materials that get ground up and spread in the soil. It helps suck down carbon from the atmosphere into the soil, which also helps improve the fertility and the yield from the soil, and it puts more money into farmers' hands, both from those increased yields and also from the carbon credits that they can sell off of it.
Now, usually when somebody wins a big $50 million prize like that, they kind of maybe celebrate and declare victory and move on. It sounds like they didn't just stop right there. And the first thing they did was to raise more money. So tell us about that.
I'm sure they did celebrate. $50 million is a pretty big slug of capital for your startup company, but they didn't want to spend that on the deployment of the technology as much as on sort of the R&D and the development. And so the deployment, they think, should be funded by debt capital, which is much cheaper than sort of equity, and certainly than this rare gift of the prize money. And so they have a new debt facility with JP Morgan, and they're already scaling up projects in India, Zambia, and Tanzania to actually deploy this on farmland. And that's the way I think that they can get to scale. They have a goal of reaching 100 million farmers, and so they want to do a kind of franchise model where local operators license the technology, but then raise their own capital to roll it out to farmers in each country.
And so this enhanced rock weathering also leads to carbon credits, right? And so it helps provide a nice financing model.
Carbon removal is the key concept, and that's in distinction to carbon avoidance. And carbon removal literally sucks carbon out of the atmosphere and reduces the carbon load. And that's going to be crucial as global emissions have not actually even peaked yet, much less gone down at the level that they need to. And so we're going to need to take carbon out, not just avoid producing more of it. And as it happens, that carbon removal credits can fetch upwards of $100. Some of the mechanized carbon removal projects like Climeworks, I think, have gotten contracts even at the like $600 a ton level, whereas the carbon avoidance credits are languishing kind of below $10 a ton. So if you can actually remove carbon and do it in a cost-effective way and generate credits north of $100 a ton, you can put real money in the hands of farmers. Mati is insisting that these local franchisees share at least half of the carbon credits with their local farmers.
All right, you can read Jessica Pothering's full piece on Monte Carbon on ImpactAlpha.com. There's a link in our show notes. But for now, David, that's going to do it for this episode of This Week in Impact. Thank you, David.
Well, thank you, Brian.
And thank you all for listening. This Week in Impact is a production of Impact Alpha and part of the Impact Alpha podcast network, smart conversations by and for impact investing professionals. For exclusive stories and insights about the world of impact investing and sustainable finance, join thousands of other agents of impact by subscribing. Just go to impactalpha.com/subscribe for full access, including access to our Slack channel where there's a robust conversation happening probably right now. Thanks as always to our producer extraordinaire, Isaac Silk. For David Bank, I'm Brian Walsh, Managing Director of the strategic advisory firm Human Nature. We'll see you next week for more Impact.